Hey everyone, welcome back to the Profitable Rental Podcast by Landlord Studio, where we explore the 6 building blocks of real estate profitability to help you maximize and grow your portfolio. Again, I'm Logan Ransley, one of the co-founders of Landlord Studio, property management and accounting software designed for small to medium-sized portfolio landlords. In this episode, we're going to explore the importance of financial literacy, especially when it comes to your real estate portfolio. And to help us with that topic, we've got Grant here.
But I am Grant Dougherty, based out of Houston, Texas. I am an enrolled agent. So an enrolled agent is just a federally licensed tax advisor. And so I can prepare taxes in all 50 states. I can also represent clients before the IRS. And I work with a lot of small business owners and real estate investors. So I am very familiar with, a lot of different taxation and tax laws regarding real estate and small businesses. So I'm looking forward to this convo today.
And sort of a part of your mission, which we've sort of seen online, is helping investors and business owners really sort of improve financial position, literacy, and you've got a lot of online resources and things to help people with that. So great to sort of see that, and I'd love to sort of dive into that today. But I guess one of the first questions I always ask guests is, what is their favorite quote, and why is that the favorite quote?
Yeah, no, most definitely. That's a really good question. So there's a bunch of really good quotes out there, but if I had to put one, say that one's my favorite, just for the podcast's sake, let's just say that it's, whatever your worth is, make sure you double that and then charge tax to it. So that's probably going to be my favorite quote to it, right? Hey, we're talking about taxes, might as well throw in a quote about taxes.
Cover all bases. So sort of starting back at the beginning of your journey, what drew you to going down this road, this career road in financial management and accounting? And particularly real estate?
That's a really good question. So, man, it really started way back in college, right? I actually went to college. I played baseball in college on a scholarship. And so really, whenever I went to school, I was really focused on just sports at the time. And I just thought, I might as well major in something that I think can probably make me money whenever I do eventually graduate. So that's what drew me to business. And I did study finance and accounting in school along with management. It was actually kind of interesting because when I was in school, you study the books and you study all the material, but that's all it was to me. It was just study material, and I'm just trying to pass a test. I'm just trying to get an A on my test. None of that stuff really clicked until after I was in the real world, and I actually had to start filing my own taxes, and I had to have a balance sheet or an income statement for my own personal taxes and also for my business. My business didn't come until a little bit later. I actually started working off in corporate America at a big company. It's called Cisco. They do food distribution. And what I did there was I was in their form of their finance department, but it was very, very specific to that company and didn't really apply to too much, to anyone else outside of that company. It's just not applicable to them. So while I was working there, that's actually when I started my business. And it started off very small, very humble beginnings. It actually started a little bit previously in college whenever I would just help some friends file their tax returns. I would essentially go to work during the day, and then at night I would, help the few clients that I did have understand their taxes and file their tax returns. And it wasn't until COVID and everything shut down, that's when I took my business very serious. I actually went and got licensed, and I started to open up. I started my social media page. I started to open up, take on more business owners and real estate investors. And during that time, I had also started working with a mentor. And this mentor taught me all sorts of different, tax laws and different tricks of the trade, and just like how to read a tax return and how to understand everything that's going on. And that's when he introduced me to real estate. And one of the most shocking things is if you take that he showed me that really stuck with me to this day was you take someone who has a W-2 job and they make $100,000 a year, and you take someone who has rental real estate. After all of the deductions, that they end up at $100,000, the same amount of income, the real estate investor will actually pay less in taxes. And that's because rental income is not subject to Social Security, Medicare. And we can go off into that a little bit further. But that's what really stuck to me. It was like, wow, okay, well, there really is a difference in the treatment of different income. And so I just, I just grew from there. And then I started, solely focusing on small business owners and real estate investors. And I found that there was an extra need for real estate tax professionals, just because even if you are a tax professional, there's so much tax law revolving around real estate that even seasoned tax professionals don't really fully understand all the nuances that really go into it. So that's when I really started to niche down and focus and really started to try to perfect my craft.
Yeah, that's really interesting. And we've actually heard that quite a few times about, this sort of light bulb moment that happens when they, compare real estate versus the W-2. And I guess it's quite interesting you talk about how it wasn't until you got into the real world where you really started to go through the process, and then going through actual tax returns, a lot of those learnings clicked. And I think that might be the case for a lot of real estate investors too, when they start to get in the sort of tax side. So are there any sort of circumstances or situations that you've been in with clients where, providing that sort of tax planning service has really made a light bulb go off for them, and then also showing them the results of that later on down the track?
Yeah, man, there are all sorts of different situations. So just one example off the top of my head is, I'm working with he's a relatively new client, and he's been in the real estate game now for years. I'm looking at his balance sheets and his depreciation schedules. He's had rental properties going back since the early 90s, right? So he's been in this game for a while, but he's never heard of cost segregation, which is a strategy to essentially, accelerate depreciation. And whenever you're trying to explain to someone who's never really heard about it before, you really kind of have to find a way to break a complex situation down to a very basic level of understanding. And luckily, I've worked with several real estate investors that have done cost seg reports. So I would just kind of take the information, dissect it out, and go and take it back to him. He's like, hey, so if you were to buy a rental property, okay, you're not only just buying the structure, right? If you're buying a single family home, you're also getting the driveway that it's on. If it comes with a swimming pool, you're getting the swimming pool, you're getting the fence, you're getting the granite countertops, all of the different, maybe if it comes with furniture, or maybe you have a dishwasher, or maybe even like a microwave. All of that stuff is part of your original purchase, but it's not part of the actual structure. And that can actually be dissected out, and you can accelerate the depreciation on those items. So for example, we're talking about depreciation and stuff. Rental properties are depreciated at 27 and a half or 39 years, which can be kind of a long time to recover your money in the form of depreciation. Things like, so for example, a driveway or a swimming pool, that actually has a depreciable life of 15 years. Right, so now you can accelerate and you can recapture that depreciation over a much shorter lifespan. You even have different things, so like granite countertops and different furnitures. That's all going to be 5-year property, right? So it's even quicker recovery time on your money. And then back in 2017, at the beginning of 2018, we had the Tax Cuts and Jobs Act, which was, now we have bonus depreciation. So people were getting 100% bonus depreciation on these items, and people were really seeing a lot of tax savings by doing cost segregation. So I said all that to essentially say that I introduced one of my clients to cost segregation, and I'm going to save him well over $50,000 in taxes this year.
Have you ever had any clients come to you with maybe an understanding of cost segregation or depreciation, but maybe not quite accurate, where there's some misconceptions or mistakes that people have made? Or have you ever seen that in the sort of industry around real estate particularly?
All sorts of people from all different walks of life. So I've looked at returns where people didn't even have depreciation on their tax return. Like it was just a blank expense. I see that relatively commonly. So if I were to just review some tax returns, probably like 2 out of every 10 or 15 probably will be missing depreciation. Usually it's going to be because it's like a self-prepared tax return. But then on the flip side, you have people who are trying to cost seg their personal residence, right? You can't take any depreciation or cost segregation against your primary residence. The only tax incentives you can get from your primary residence are going to be, you get a mortgage interest deduction, which goes on your Schedule A as an itemized deduction. And you can also deduct up to $10,000 in real estate taxes. And so that's essentially the primary deductions that you can get, primary residence. Now, if you do sell your primary residence and you lived in it for 2 years in a 5-year span, you can qualify for the Section 121 exclusion, which allows you to sell your primary home. If you're single, you can exclude up to $250,000 in capital gains. And if you're married, filing jointly, it's $500,000. Those numbers, $250K and $500K, they have not been adjusted for inflation since like the early 90s, right? So there's all sorts of different tax provisions that haven't received any type of update, inflation update. Probably the most shocking one is going to be capital losses. Not to get too far off track, but you can take $3,000 of excess capital losses and offset your income every year. That $3,000 has not been updated since like the 70s or 80s. And so if that would have been adjusted for inflation to today, that number should be around $14,000 or $15,000.
I guess these are sort of all the types of, not loopholes, or maybe you consider them loopholes, but tax strategies that are really important to consider that you'd never really learn about as a real estate investor if you didn't engage with the CPA who knew what they were talking about. I often find a lot of the real estate sort of accountants the accountants or CPAs that real estate investors are using or engaging with may not even know many of these things either, because they don't really specialize in this sort of real estate vertical. So I guess for listeners to sort of consider when it comes to choosing a CPA or accountant in this industry to maximize tax gains and losses, what is some advice for them in that sort of decision-making cycle?
You got to find out what exactly your goals are. You have to know what your goals are. And when you know what your goals are, just talk with them. Word of mouth is always a great one. So if you are looking for someone very specific that is into real estate taxes, you could even ask your current CPA and see if they may know someone, right? I've had people ask me, I wouldn't consider my niche to be in trusts, right? So anytime someone comes to me asking for trust tax tips, I always refer them to someone who I know can handle them really well. So that's always one way you can go about it. But if you're just interviewing some people, I would just ask them, a few questions like, what is their experience with working with real estate investors? Ask them different questions about real estate professional status and even short-term rental strategies, just to see where their knowledge is or how they're feeling about different situations. And you just have to ask, different deep questions like that to really see if they understand what you were talking about. Of course, do your own homework and then take that homework and go and ask them these questions. But usually it's going to be word of mouth. That's usually the best way to find, at least in my experience, is the best way to find the professional that you're working with. And you actually mentioned something earlier, man. So you mentioned something about loopholes. So I have a bunch of different tax friends in the industry, right? So
Tell us about some of those.
Yeah. So, we're always talking, and it's funny because one of the things that always gets people worked up is whenever you say the word loophole, they're just like, you talk to someone, they're gonna be like, oh, loophole. I guess not a loophole. Red flags. Right there. Yeah, it says it right there in the tax code. But as true as that may be, usually whenever you hear someone referring to the word loophole, it's because when the law was initially written, it was intended for one purpose, but then people found to use that law to use it for a completely different purpose. So for example, the most common one is the short-term rental. I say strategy, but technically it's a loophole, because back when Congress initially put in the passive activity loss limitations, they did have a few exceptions to the rule. And one of them was, if the average tenant stays for 7 days or less, you don't have a quote unquote rental activity in the eyes of the IRS. Now, back in the 80s, when they wrote this, the internet really wasn't a thing in everyone's household. So they weren't really considering the fact that, one day people are going to be able to hop on the Airbnb, buy a house, and just have the average tenant stays for 7 days or less, right? So that would be an example, right? They wrote this law and they put these provisions in place to really assist the hotel industry, or like the bed and breakfast industry. Like, that's really why it was written, was to assist them, to make sure that they didn't get caught up with unfavorable tax laws. Well, then as technology developed and the times changed, people started using that law to now invest in short-term rentals, your current day Airbnbs, and now it's a very lucrative strategy that a ton of real estate investors implement.
Yeah, so that's quite interesting. And I guess as clients sort of come to engage with your services, then sort of considering all those different tax strategies and loopholes, how are you sort of balancing between minimizing tax liability through, deductible expenses and all these other strategies, and sort of maintaining compliance with tax law to make sure that you're not going too far or too little over this line area where it can be different for every sort of CPA?
Right. That's a really good question. So, I'm big on researching history, right? So one of the things that I personally do whenever it comes to like involving my tax strategy is I like to look at how has the tax court treated similar situations before in the past, because that can give us an idea as to how the tax court will treat certain cases in the future. And so that's usually what I do is I like to look at if someone comes to me with something that is very uncertain, it could fall into that gray area. I'll go back and I'll try to do some research to see if there's a court case on something very similar. Now, usually a lot of times, so there are cases where it does fall into a gray area, but I would say about 85 to 90% of the time, I usually can, answer, like I've read enough court cases to where I can say like, oh no, this has happened before, don't do this. Or, oh yeah, by the way, someone actually took this to court. The court ruled in their favor because they did X, Y, Z. And so that's how I generally go about something like that.
In your view, what's the sort of importance that bookkeeping plays in this sort of leveraging of the tax law and using software to do that, or building systems in their business to make sure that they're capturing every single expense?
That's an amazing question, man. Bookkeeping, you can't do anything without bookkeeping. In fact, if you were to come to me and ask for tax strategies, the very first thing I'm going to do is say like, all right, let me see your profit and loss statement. Like, let me see what we're dealing with. And if you haven't done your bookkeeping to get those profit and loss statements ready, then it's completely pointless. We can't do any type of tax strategy. So whenever I look at something like that, I compare it very similar to building a house, right? You're not going to build a house and the very first thing you're going to do is build the swimming pool, or you're not going to build the master bedroom upstairs, right? You're going to start with the foundation, and that's essentially what bookkeeping is for any type of real estate investor or business owners. You have to first have a strong foundation, and bookkeeping is your foundation in the world of business. So that's how bookkeeping is ultra important. In fact, I would say, I don't want to say it's more important than having a good tax advisor. I'd say they're about hand in hand, but you can't do any tax advising unless you have your books done. Very, very important.
It's also the least sexy part of the entire process of real estate investing. Seems to be the thing that everyone leaves till the very last minute. At least from what we've seen.
Oh yeah, no, I mean, same here, man. Usually whenever you have to put people on extension, or if they're trying to get their stuff, so if the deadline is April 15th and they get you their stuff April 1st, it's usually because they just now got their books ready, and now, okay, now we're ready to go. And this is, 4 months into the year now.
Awesome. And I guess to sort of wrap up today, I've seen a lot of your online educational material. You've got a website, you post a lot on Instagram, etc. I guess generally sort of summing it up, what's some key advice that you would provide to a real estate investor who are either at the very beginning of their journey, or a little way through their journey, are looking to scale to sort of achieve that goal of financial success and freedom? What's some sort of takeaway advices here?
Number one, never let the tax tail wag the dog, right? Don't go and start investing into real estate because you heard that there's good tax incentives. Always want to make sure that it is a smart financial move first, and that what you are investing in will actually produce a return, right? Don't just go and get a short-term rental because you heard that you could, take depreciation against your income. No, that's not why you do it. You want to make a smart move. And then number two, when you get started, don't overcomplicate things. That's something that I see a lot is people get going and, okay, I just bought my first rental. Now, I think I want to 1031 exchange it in 2 years or something like that. And it's just like, whoa. Like, let's slow down here. Like, let's figure out how does this work? Like what is the actual process and what does it actually look like to own real estate and to be a real estate investor, right? You don't overcomplicate it. I see people come to me all the time. They're like, hey, like, should I put my properties in a corporation? And a quick little tip, everyone out there, do not put your rental properties in a corporation. S Corp or C Corp, just don't do it. Just leave it either in your personal name or in an LLC. LLC gives you that limited liability, that legal protection, but to get favorable tax incentives, you actually don't need an LLC to get that.
Yeah, I actually heard that on the last podcast episode that I did as well. And I think that's also a misconception that people just don't really understand. So good takeaway there, and we'll definitely sort of highlight that in today's podcast episode. But great to have you on here, Grant. And where can the audience find out about you? Where are you on social? How can they learn more about you?
Yeah. So, if you want to follow me on Instagram, that is probably my biggest channel. It is Dougherty Tax Solutions. So DOUGHERTY Tax Solutions. You can follow me on Instagram. On Twitter, all of my content before it gets posted onto Instagram usually has to go through Twitter. And actually, a lot of the content from Twitter never does make it over to Instagram. So if you ever want to see probably a little bit more of me just freely speaking my mind, you can follow me on Twitter. It's DOU Tax Solutions. So Twitter has that thing where you can only put so many letters in your handle. So it's DOU Tax Solutions on Twitter.
We'll chuck a link for those in today's episode and write up as well. So amazing to have you on here, Grant, and yeah, really appreciate your time. If you like this episode, give it a like and a share. And if you want to listen to more insights and tips, subscribe to the channel, keep up to date with the podcast, and follow us on all social media. Just look for Landlord Studio as well, and we'll share more of those tips and tricks around tax strategies, etc. And also stay tuned for the next episode of the Profitable Rental podcast as well. And until next time, appreciate it, Grant, and thank you very much for joining us today, and have a great week, everyone.